This is what happens when a farmer grows the perfect crop, sells it at the perfect price, and still goes bankrupt. Not because the harvest failed, and not because buyers disappeared, but because the financial tools built to protect that farmer turned into the very thing that wiped them out. Most people assume that if you grow food the world needs, at a price the market supports, you're safe. The potato paradox proves the opposite, and it exposes a fault line running from a wheat field in Kansas, through a clearinghouse in Chicago, to a shipping lane in the Red Sea, one capable of collapsing the entire chain at once. Over the past 20 years, the global agri-food system has gone through a kind of mutation. What used to be a localized, weather-dependent production network has turned into something else entirely, a highly financialized asset class wired into global capital markets. Passive index funds, exchange-traded funds, hedge funds, and waves of speculative money have rewritten how food prices move, tying them directly to equities, debt instruments, and energy markets around the world. That connection made agricultural commodities far more vulnerable to systemic shocks, volatility spillovers, and contagion from crises that have nothing to do with farming. Between 2018 and 2024, the consequences arrived all at once. The US-China trade war hammered export routes, climate-driven floods and multi-year droughts destroyed harvests, COVID-19 paralyzed logistics networks, and Russia's invasion of Ukraine sent energy prices into the stratosphere. By mid-2022, global spot wheat had blown past 1,200 cents per bushel, while nitrogen fertilizer costs more than tripled. At the same time, drought slashed daily vessel transits through the Panama Canal from 36 down to 18, and Houthi rebel attacks effectively shut down the Red Sea and Suez Canal to commercial freight. Ships rerouted around the Cape of Good Hope, adding weeks to delivery schedules and inflating container freight rates by as much as 417% on Asia to Europe routes. Understanding why all of that can bankrupt a perfectly healthy farm business requires looking at how agricultural hedging actually works, and more importantly, at the exact points where it breaks apart. The financial threats along the agri-food value chain look completely different depending on where you sit. A farmer, a grain elevator operator, and a multinational commodity trader each face a distinct set of risks, and each one can be destroyed in a different way. Farmers and primary producers are naturally long on physical commodities, which means their core danger is a collapse in output prices. About 90% of hedging among smaller agribusinesses relies on forward contracts, primarily because they're simple, carry no margin requirements, and can match the size and timing of the physical crop exactly. What makes producers especially fragile is their cash flow cycle. Seasonal revenues that don't arrive until autumn, paired with short-term operating debt taken on every spring to cover seeds, fertilizer, and diesel. Processors, millers, and grain elevator operators face the reverse problem. They need to buy raw commodities constantly, which means their nightmare scenario is a sudden spike in input prices. When those costs surge and can't be passed along to consumers fast enough, operating margins can disintegrate in a single fiscal quarter. These firms run complex cross-hedging strategies and over-the-counter swap structures, and their working capital sits locked inside physical inventory stored in silos. That makes them extremely sensitive to sudden valuation haircuts and margin calls when prices drop without warning. At the very top of the chain sit companies like Archer Daniels Midland, Bunge, Cargill, and Lewis Dreyfus, the so-called ABCD traders. They operate vast networks of physical assets, shipping fleets, and proprietary trading desks, hedging through major exchanges like the Chicago Board of Trade and the Intercontinental Exchange with futures, options, and custom swaps. Even with deep capital reserves, the sheer volume of their open positions demands constant liquidity at risk modeling to make sure billions of dollars in liquid assets remain available when macroeconomic shocks trigger massive margin calls. And this is where the paradox takes shape. When agricultural hedgers use centrally cleared derivatives, they post only a fraction of the total asset value as initial margin, effectively trading on leverage. That leverage creates severe liquidity risk, because both daily and intraday variation margin settlements must be funded in real time. During extreme volatility, those margin calls accelerate into a pro-cyclical force, converting what starts as a theoretical price risk into an immediate operational cash crisis. Here's how the mechanism works. When prices spike, Central counterparties don't just sit there. They dynamically ratchet up margin requirements to match the new reality. A single exogenous price shock drives variation margin higher through massive daily price gaps, while simultaneously pushing initial margin higher through updated volatility parameters. Corporate treasuries get hit with a synchronized liquidity drain at exactly the moment when borrowing becomes most expensive and credit lines start tightening. That pressure is precisely why many of the more sophisticated agribusinesses have started shifting toward over-the-counter derivatives provided by banking syndicates. Under these customized agreements, banks can waive initial margin requirements entirely for highly rated clients and eliminate variation margin posting even when positions move against the hedger. The bank absorbs the intraday liquidity risk in exchange for a premium built into the derivative pricing. By swapping exchange-traded futures for bespoke OTC structures, agri-food firms can preserve hundreds of millions of dollars in working capital, money that would otherwise sit frozen in clearinghouse accounts. But here's the thing, there is another category of risk hiding underneath all of this, one that most people outside the commodity world never think about. It's called basis risk. The entire economic logic of the futures market depends on one principle: convergence. As a futures contract approaches its expiration date, the local physical cash price and the exchange-traded futures price should move toward each other until the gap between them, known as the basis, becomes small and predictable. When that convergence fails, the results can be far worse than a simple price drop. During the 2007 to 2008 agricultural rally, the wheat basis blew out to negative 50 cents per bushel right at contract expiration, a staggering gap that shattered hedging assumptions across the industry. Years later, when the US-China soybean trade deals collapsed, millions of metric tons of unreported physical supply got trapped inside the domestic market, widening the local basis so dramatically that it signaled severe delivery breakdowns well before any official government data confirmed the cancellations. What drives these blowouts is built into the contracts themselves. Agricultural futures give the short position, the seller initiating delivery, significant flexibility over timing, location, and commodity grade. That flexibility functions like an embedded exchange option, and when volatility spikes during a systemic shock, the value of that option balloons. Futures prices stay artificially elevated relative to cash prices. The expected convergence never happens, and standard hedging models become useless. The 2008 agricultural food crisis laid this bare in devastating detail. Over just 15 months, the FAO Food Commodity Price Index surged 71% in nominal dollar terms, driven by rising demand from emerging economies, stagnating crop yields, and the diversion of agricultural output into agro-fuel production. What turned a price spike into a hedging catastrophe was the flood of speculative capital pouring in from institutional index funds and hedge funds scrambling for non-correlated returns, as equity and mortgage markets crumbled. That speculative wave ripped futures benchmark prices away from physical spot prices in local markets, triggering a catastrophic global basis blowout. Corn hit $8 a bushel on the Chicago Board of Trade. Commercial hedgers who had shorted agricultural futures to protect their physical inventory found themselves buried under margin calls they couldn't meet, because futures prices had been inflated by speculative buying, while the actual cash prices in their local markets hadn't moved anywhere near as fast. The physical asset couldn't offset the derivative losses. Across the developing world, the food import bill jumped from $191 billion in 2006 to $254 billion in 2007, and an estimated 75 million additional people fell into undernourishment. April 2020 produced something even more extreme. West Texas Intermediate crude oil for May delivery didn't just fall. It collapsed to negative $37.63 per barrel. The trigger was a global evaporation of demand from COVID-19 lockdowns that exhausted all available physical storage at the Cushing, Oklahoma delivery hub. Excessive long positions held by financial traders, including retail-heavy exchange-traded funds with no capacity to take physical delivery, created immense closing pressure. Quantitative simulations later showed that, while the genuine storage shortage accounted for roughly $7 per barrel of the decline, the plunge to negative $40 was driven entirely by intraday market dynamics and predatory trading. Commercial producers watched their physical wellhead prices stay positive, though deeply depressed. None of that mattered, because their contracts and hedges were formally linked to the WTI Cushing benchmark, which meant they were forced to settle at the catastrophic published price. The event proved something many had only theorized about. When physical storage constraints collide with rigid financial delivery mechanisms, a derivative can behave in a way that has absolutely no connection to the asset it's supposed to represent. And then, March 2022 showed what happens when the clearing system itself nearly breaks. Following Russia's invasion of Ukraine, fears of supply sanctions on Russian nickel, which represented roughly 17% of global high-grade supply, triggered a massive short squeeze on the London Metal Exchange. Over 3 trading days, nickel prices exploded by 270%, including a 69% intraday spike that pushed the metal past $101,000 per metric ton. Tsingshan Holding Group, one of China's largest nickel producers, held a short position, estimated between 100,000 and 300,000 metric tons, as a legitimate commercial hedge against future production. When prices detached from all physical reality, the margin calls became existential. LME. Clear issued an aggregate initial margin call of approximately $7 billion. Tsingshan alone faced a $1.1 billion variation margin call on its cleared positions, plus an estimated $4.4 billion on uncleared OTC positions. One single account breach hit $2 billion, which eclipsed the exchange's entire default fund of $1.1 billion by 182%. The daily breach rate shot to 8.1% of all accounts, up from a historical average of just 0.003%. With up to 12 of its 45 clearing members on the brink of default, and internal models showing that the $19.75 billion in intraday margin calls required on March 8th would collapse the exchange entirely. The LME suspended trading and retroactively canceled 8 hours of agreed trades. Elliott Management filed for $456 million in lost profits. Jane Street sought $15 million, and the legal and regulatory fallout continued for years. Physical logistics compound every layer of this financial fragility. Rerouting around the Cape of Good Hope to avoid the Suez Canal adds roughly 5,600 nautical miles, extends bulk voyage times by up to 20 days, and burns an additional $30,000 per day in fuel and operating costs. An agricultural shipment worth $15 million, carrying a 15% annual carrying cost, absorbs about $6,164 in daily financial burden, which means a 20-day diversion creates over $123,000 in pure, unrecoverable carrying costs on a single voyage. Those delays do more than inflate shipping bills. They trap working capital on the ocean, reduce inventory turnover velocity, and force processors to stockpile larger safety reserves. Under extreme logistics uncertainty, safety stock calculations have to be anchored to the worst-case scenario, meaning the 34-day transit of an African detour rather than the historical 14-day Suez average. That defensive posture drains revolving credit lines faster, piling on interest expenses and squeezing liquidity buffers at exactly the moment conditions are already tightening across every other part of the system. The credit itself carries its own form of time bomb. Agri-food firms fund their operations through asset-based lending structures, governed by borrowing bases that shift with market conditions. Liquid accounts receivable typically command advance rates between 70 and 85%, while physical commodity inventory receives lower rates of 50 to 60%. When commodity prices drop, the marked-to-market value of silo inventory falls with them. The borrowing base contracts, and any firm whose outstanding loan now exceeds the shrunken base enters what lenders call a deficit state. That triggers an immediate margin call from the lending syndicate, demanding rapid cash injection to restore the collateral ratio. What makes this worse is how lenders behave during crises. Rather than holding steady, banking syndicates engage in defensive posturing, proactively slashing advance rates. Cutting inventory advance rates from 60 down to 40% artificially accelerates the credit contraction, forcing firms into desperate asset liquidations that push prices even lower and deepen the spiral. Debt covenants amplify the destruction further. Consider a firm generating baseline EBITDA of $10 million, bound by a covenant that caps interest payments at 40% of EBITDA. At a 5% interest rate, that firm can carry up to $80 million in debt. When rates climb just 1 percentage point to 6%, maximum debt capacity drops to $66.7 million. That's a 20% destruction of fundamental borrowing power, caused entirely by external rate movements the firm has no control over. And when multiplied across thousands of firms, it creates compounding downward pressure across the entire agricultural economy. Building resilience against all of this requires a governance framework that treats risk as something to be anticipated rather than reacted to. The 3 lines of defense model, endorsed by the Office of the Comptroller of the Currency and the Basel Committee, provides the structural foundation. Frontline business units form the first line, generating and managing risk at the point of origin. The second line is the independent risk management function, operating separately from revenue-producing divisions. Internal audit sits at the third line, reporting directly to the board and providing independent assurance that the entire system actually works as designed. The liquidity coverage ratio from Basel III mandates that institutions hold enough unencumbered, high-quality liquid assets to survive a severe stress scenario lasting 30 calendar days. Level 1 assets, which include central bank reserves, sovereign debt, and cash, can be converted to liquidity at full value even during systemic panics. Level 2 assets like corporate bonds and agency mortgage-backed securities carry mandatory haircuts. Every asset in the HQLA pool must remain completely free from legal, regulatory, or operational encumbrances. Key risk indicators serve as the early warning system, organized through a traffic light methodology that maps specific thresholds to escalation actions. When the liquidity coverage ratio falls below 100%, when value at risk utilization pushes past 90%, when the non-performing loan ratio climbs above 4%, those crossings function as hard-coded triggers that mandate an immediate convening of the Executive Risk Committee and activation of emergency funding plans. During a full-blown liquidity crisis, the response framework shifts into a 13-week direct cash flow forecast model, translating balance sheet exposure into a day-by-day countdown of remaining operational cash. Within the first 72 hours, the crisis team must lock in 3 to 6 months of guaranteed cash flow, impose cost containment measures cutting non-essential spending by 15 to 25%, and renegotiate supplier terms to extend payables by 30 days or more. All of which brings us back to where this started. A farmer can grow a flawless crop. A trader can execute a mathematically perfect hedge. A processor can fill every single order. And the whole thing can still come apart. Not because of what happened in the fields, but because of what happened in the clearinghouses, in the shipping lanes, in the credit agreements, and in the boardrooms where covenant thresholds got written years earlier. Standard risk models relying only on mean and variance, the first 2 statistical moments, consistently underestimate true exposure. At a 99% confidence level, traditional conditional value at risk for wheat came in at negative 2.341. When the extreme skewness and heavy kurtosis of wartime markets were factored in through the Cornish-Fisher expansion, modified CVAR expanded to negative 4.249, nearly double the threat level predicted by conventional tools. A treasury team relying on the traditional number would have undercapitalized their liquidity reserves by close to half. The agri-food system isn't just about food anymore. It's a financial system, wired into energy markets, sovereign debt instruments, global shipping logistics, and speculative capital flows. Until the governance frameworks, the risk models, and the financial architecture catch up with that reality, the potato paradox will keep repeating itself. The perfect harvest will go on producing perfect bankruptcies.